I'm curious when it comes to getting financing for a home for your, let's say your first home or another home versus getting or not refinancing, but for a home equity line of credit. Is one easier or harder than the other to attain?
Well, actually, in a lot of cases, a lot of situations, getting the HELOC can be more difficult.
Hmm.
Um, and primarily the reason for that is the what I would call the core HELOC product in the industry. It's a variable rate loan, and it's variable because it's tied to prime. The prime rate, the Wall Street Journal prime rate, they call it. Now that rate is a short-term rate, and therefore it directly is correlated to the Fed funds rate. And so a variable rate HELOC tied to prime, it's called variable because the rate can change whenever the Fed funds rate changes. Well, from the underwriting perspective, after the lessons we learned in 2000, before 2008, the homeowner, the borrower on a variable rate HELOC is not going to be qualified at the initial rate on the loan. That's because it's variable. The rate
Hmm.
could go up. So what lenders now do, what the industry now does to maintain focus on the ability to repay, which means being able to qualify based on debt ratio, but then also in a variable rate loan situation to take into account the potential for increases in the rate, not a decrease, you are typically going to be subjected to a formula that says, okay, I'm getting a HELOC at 8 3/4. In fact, I sent out a worksheet this morning for someone on a rental property. They wanted a HELOC for $500,000.
Wow.
And I was able to price it out and offer them an 8 3/4% rate, which is very good for a HELOC on a rental property, especially for that loan amount.
Hmm.
But if the person decides to go forward with it, we're not going to qualify them, and we're not going to calculate the debt ratio based on 8.75. We're going to calculate it based on the index plus margin, which in this case is prime plus 1 1/4. That's how you get to 8 3/4, plus 2%.
Wow.
So the borrower is going to have to be qualified at an assumed rate of 10.75, and based on not interest only, which is the minimum payment available on that HELOC, but fully amortized. So when you take into account a fully amortized 30-year payment based on a rate 2% higher than the starting rate you're going to get, it's tougher to qualify. You have a
Wow.
greater risk that you're going to miss based on debt ratio. And so that can be a real issue in a lot of cases. And we run into that more, actually, quite a bit more often with older homeowners who maybe have a little bit different income level than they did before, maybe relying more on retirement income. And they're thinking, oh, I got a ton of equity. Getting a HELOC is going to be easy because I have an 800 credit score and I've got, 70% of my home value is equity. So I should get the loan just because of that. Well, no, ability to repay says we still got to make sure you qualify on debt ratio. So we got to look at your income, look what the payment is. And then if the qualifying payment is inflated on purpose to make sure you don't default, then whoops, suddenly your debt ratio is 55, you can't get approved. So we do run into that more often, and that's why a HELOC oftentimes can be harder to qualify for than a traditional fixed rate mortgage. Now, that being said, we have a unique product, which is a HELOC, but it's called a fixed line HELOC, meaning that the loan, when you get it, you get a rate that's fixed. It's not tied to the prime rate. It's a traditional fixed rate loan. Most of the ones we do are on a 20-year term. And because it's fixed on a 20-year term, you do get to qualify at the start rate because it's never going to change.